Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Steve Sosnick to discuss why major volatility indices are better thought of as contrarian indicators and predictive indicators. Steve is a chief strategist at Interactive Brokers. Steve, it's great to see you as always. Welcome back to Trade Talks. And I can't tell you how many traders tell me, Jill, it feels like the VIX isn't quite working like it should. What do you think they mean by that? And why do you think it's more of a contrarian indicator?
Hi, Jill. As always, it's a pleasure to be here. Well, it's one of these like persistent questions, and it's important to remember what VIX, VolQ, VXN, et cetera, are supposed to be measuring, and that is the 30-day, the market's best estimate of 30-day volatility. They use different measures. VIX and VIXN use basically every option that has a bid with a 23 to 37 day time to expiration. VolQ sticks to options that are more or less right around the money, 3 up, 3 down kind of thing. So it's meant to be a bit purer read of at money volatility. But the bottom line is these are all 1 month look aheads. At least that's their intention. And the reason they do this is they're looking at what the implied volatilities are of whether it's NDX or SPX options out, in that time period. And the problem is what we call recency bias. It's not my term. It's a fairly standard psychological behavioral economics term. And that is people tend to think of whatever's going on at present or most recently gets a heavier weighting in their thought process than do further out events. So we tend to extrapolate the present or the very near past into the future more heavily than we do the longer term. And so going back to the chart that was just up, what we see is this is VolQ is the blue line, and the yellow sort of jumpy columns are the past 1 month change in NDX. And we see that basically they go together. So when the index is returning poorly, VolQ, and the chart looks essentially the same whether we do VIX, VIXN, it doesn't really matter. But you'll notice that the demand for volatility goes up when prices are down, and the demand for volatility goes down when prices are up. And you see they move almost in perfect lockstep. And so when people say that these indices aren't working, that these measures aren't working, they tend to say, oh, it's because everybody's trading the short-term options. It's not true. People are still trading the longer-term options. As a percentage, they're trading many more short-term options, but the volumes are still there. It's just that right now there isn't a demand for hedging, and then these products, these bigger term volatility products, VIX, et cetera, they're proxies for institutional demand for hedges. And the bottom line is people don't demand it so much when they don't need it.
Well, it's interesting, Steve, because you've often compared yourself on the time, at your time on the floor as an options market maker to that of an umbrella salesman, right? So tell us what you mean by that.
Exactly. Well, here's the thing. If you're selling umbrellas, you have this inventory of umbrellas that is available for sale. When it hasn't rained in months and and people just sort of generally think, oh, it's not going to rain again anytime soon. What are you going to do if you need to move the umbrellas? Well, you have to cut the price, and there's not a lot of demand for them. As soon as those clouds appear on the horizon, as soon as those first couple of drops fall, the price of umbrellas goes up dramatically, and that's really what we see here. Is these volatility products? They're your umbrellas for when markets are stormy or cloudy. And right now, what we've seen is just people have not really felt the need to protect themselves. The markets have gone up. They haven't had a lot of volatility. So why do I need to protect against that sort of thing? The problem, though, becomes we're at a point now where it becomes what I would call a one-tailed trade. If these indices start to go down, I'm just going to use VIX as a proxy because it's so well known. But when we talk about VIX, in the low teens or even with a 12 handle, where's it going to go? We're talking very close to its record lows. And if it's going to get there, if it's going to go down, it's going to go down slowly and incrementally. If it's going to go up, it can go up in a hurry. I think about early last month when we went from 15.5 on VIX to 21.5 in 2 days. Mm-hmm. And so because what happens is everybody races in to get the protection that they're lacking. We can argue that a lot of the institutions are not looking for the type of protection that they needed to before, or used to before, because they've done a lot of the de-risking themselves. But if is anecdotally the case that they've sort of been piling into a lot of these, mega cap tech winners, to capture the performance, particularly as we get into quarter end, that sort of, raises the prospect of maybe some protection is starting to be needed again. And of course, although nothing came of the events over the weekend, my first comment, a reporter reached out to me 9 o'clock Saturday morning. What do you think is going to happen? And I said, if nothing else, I wonder whether this wakes VIX out of its stupor. And I do think that, although thankfully the geopolitical events didn't really amount to anything, I think we need the reminder periodically that this stuff matters and that these things come out of the blue. And when you need the protection, it's much harder to come by.
Mm-hmm. Yeah, and Steve, you and I have covered this a number of times before, that the lower the VIX is, when you do have those pops and vol, it happens. It's more noticeable when it's lower than when it's at a higher level. So I think it's important. But if you think about it as a contrarian indicator, if it has a 12 or 13 handle suggesting that there's a lot of bullishness out there, wouldn't you want to put on some protection? Because in theory, it's cheaper. And if you're thinking like a contrarian, if everybody is so bullish, maybe, take the contrarian trade.
That's why you're good at your job, Jill, because you just summed it up perfectly. Yeah, that's exactly it. If everybody's complacent, then you should be nervous. Be greedy when others are fearful, and fearful when others are greedy. And VIX, it tends to be a bit more of a mean reverting trade. A lot of the volatility trends tend to be mean reverting rather than stocks, which do not necessarily need to be mean reverting. If it's somewhat mean reverting, that is when you literally want to be buy low, sell high, because there is sort of a general tendency, a general average that you can trade around. And if you're below average for a sustained period of time, you have to start to wonder, does it start to move back to the more normal historical longer term trends that we've been following? If that's the case, you've got a few points that you could make in a very quick period of time. And that's, to me, why I tend to think of it in a contrarian fashion, because again, when people are very nervous, they come clamoring for these products, and that's when you see their futures curves invert, and there's a relative scarcity in the short period of time, and then it tends to abate once people have the protection. So this is the flip side of it. So that's again why I consider it contrarian, and why buy low, sell high doesn't fail to apply here.
All right, Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.